Every January, one government report triggers billions in market swings and locks in the fate of United States farms. This year, with the Farm Bill safety net frozen for a third time and fertilizer costs up 20%, producers face a brutal reality. The numbers released on January 12th will dictate who survives 2026 and who cannot plant at all. Why has policy stood still while farm economics spiral out of control? The answer begins now. At exactly noon on January 12th, 2026, a single government document will land on trading desks across the country. The USDA World Agricultural Supply and Demand Estimates, known in the grain world as the Big One, arrives with the final word on last year's harvest. For months, farmers and traders have watched markets guess at what is in the bins and what is still left in the fields. But on this day, all speculation ends. The numbers are locked, and so is the foundation for the year ahead. The January report does not simply summarize what happened in 2025. It sets the price baseline for every bushel to be planted, sold, or stored in 2026. Grain elevators, processors, and exporters use these figures to reset their cash bids within hours. A surprise in corn yield, just 2 bushels per acre above or below expectations, can move futures markets by 20 cents or more, translating into billions of dollars changing hands before the trading session closes. For corn alone, 500,000 contracts may trade in a single afternoon, each representing 5,000 bushels. Soybean and wheat markets react instantly as production and stocks-to-use ratios are revised in real time. The stakes are immediate. If the report shows higher than expected corn yields, prices can drop below $4 per bushel, slashing farm income and forcing tough decisions before spring planting. Lower yields, on the other hand, might trigger a brief rally, but rarely enough to close the gap between rising input costs and stagnant reference prices. For soybeans, the production number sets the tone for the entire year, influencing which crop farmers will favor as they lock in seed and fertilizer orders. Wheat carryover stocks, revealed in the same release, signal whether prices will recover or continue to sag. This single report ripples outward, dictating not only contracts and cash flow, but the very acres that will be planted in the coming weeks. By the end of the day, the future of thousands of farms will be reset, not by weather or policy, but by the data stamped on the USDA official release. The 2018 Farm Bill, stretched by a third short-term extension, now holds through September 30th, 2026. For farmers, this means another year locked to support formulas written nearly a decade ago, even as the economics of agriculture have changed beyond recognition. The reference price for corn remains frozen at $3.90 per bushel, a number that once matched the cost of production, but now falls far short. In 2026, growing a bushel of corn costs more than $5 on average. The gap between what policy covers and what farmers actually spend widens with each passing season, leaving many without a functioning safety net. This policy freeze comes as input costs mount on every front. Fertilizer prices, already volatile, have surged another 10 to 20% compared to last year. Nitrogen, the backbone of corn production, is up 15%, driven by rising natural gas prices and supply constraints. The link is direct. Natural gas is the main feedstock for nitrogen fertilizer, and global energy markets remain unsettled by ongoing geopolitical tensions. Phosphate prices have climbed 12%, while potash costs keep rising despite plenty of supply worldwide. Sanctions on major exporters and shipping disruptions have pushed prices higher in North America, squeezing margins even tighter. The Farm Bill's unchanged safety net programs, like agricultural risk coverage and price loss coverage, were designed for the economics of 2018. They offer no adjustment for the cost spike farmers now face. no mechanism to reflect the reality of doubled expenses. Conservation programs, too, are stuck at flat funding levels, despite more farmers seeking enrollment as a way to manage risk. Crop insurance subsidies remain static, providing little extra relief against the backdrop of soaring premiums and tighter credit. These unchanged programs leave producers exposed. With the deadline for a new farm bill now set for the end of September 2026, Congress has left producers to navigate a world where policy and market realities no longer align. Each extension buys time in Washington, and it costs farmers on the ground. The result is a widening chasm between what the safety net promises and what it actually delivers, especially as input costs accelerate with no sign of relief. Corn prices, holding at $4 to $4.20 per bushel, leave producers facing losses of $50 to $150 per acre. The arithmetic is unyielding. Average production costs have climbed past $5 per bushel, with fertilizer, seed, diesel, and land rent all surging. Seed alone now costs a corn grower around $120 per acre, while soybeans require just $60 to $80 per acre. With input bills rising and revenue shrinking, the old safety net offers no relief. Reference prices are frozen, and most farms see no payout. Across the Midwest, the response is visible in the fields. USDA models project a 3.7% keat in corn acreage for 2026. Soybeans, less hungry for fertilizer and easier on cash flow, are set to rise by 2.5%. Some producers, especially those operating on rented ground, are sitting down with landlords to negotiate lower rents, pointing to the stark gap between market prices and break-even costs. Others are weighing whether to plant at all, as the risk of losing money per acre outweighs the hope of a late-season rally. For younger operators and mid-sized family farms, the pressure is acute. Many have invested in high-efficiency corn equipment over the past decade, now seeing those planters and combines idle as acreage shifts away from corn. Crop rotation plans are stretched thin, with too many consecutive soybean years threatening long-term soil health. But the math of survival leaves little room for ideal agronomy. Some fields may go unplanted altogether, a last resort for those who simply cannot justify another year of red ink. The margin squeeze is now dictating not just what gets planted, but whether certain acres are farmed at all. The promise of the One Big Beautiful Bill Act, passed in December 2025, hangs on a sharp edge. On paper, the incentives are sweeping. Farmers can expense up to $1.2 million in equipment purchases immediately, with 60% bonus depreciation for precision agriculture technology. GPS guidance, variable rate applicators, and advanced soil sampling are all eligible. But there is a catch that few can escape. These tax breaks only matter if a farm is making money. For most, losses have wiped out taxable income. Depreciation deductions cannot generate refunds for years already deep in the red. The relief is theoretical, not real cash in hand. Banks see the numbers and react with caution. Operating loan rates have doubled since 2021, now sitting between 8% and 10%. Lenders, watching margins evaporate and balance sheets stretch thin, demand more collateral from every borrower. Some banks have started shrinking their exposure to agriculture entirely, cutting back on new loans and tightening the screws on existing ones. Young farmers, often carrying the highest debt-to-asset ratios, face the greatest scrutiny. Co-op managers report that even the most established operations are being asked for more guarantees before any line of credit is renewed. Meanwhile, the export picture adds another layer of strain. China-S corn imports from the United States have fallen by 40% compared to 5 years ago. Record crops out of Brazil and Argentina are flooding the global market, driving prices lower and making it harder for American grain to find buyers. The strong dollar only sharpens the pain, pricing United States exports out of reach for many countries. As one co-op manager says, "We are seeing bins full, but contracts slow. The world has plenty of grain, and we are left waiting for demand that may not come." The result is a bottleneck with no easy fix. Policy incentives dangled just out of reach, credit flows tightened, and the world's appetite for United States grain continues to shrink. For many farms, the numbers simply do not work, no matter how many times the rules are rewritten. As input costs soar and policy stalls, American farms stand on a razor's edge. Each January report now decides not just profits, but survival. The gap between economics and policy grows wider until it closes. Every acre planted is a gamble. What would you do in their place?